UK Tax Podcast, transferring a property business to a limited company, with John Kavanagh. Welcome back to the UK Tax Podcast. My name is John Kavanagh, and I'm a chartered tax advisor with my own private practice. I mainly advise other professional advisors, but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. In today's episode, we'll be discussing the incorporation of property portfolios owned by partnerships and LLPs into limited companies. This is a strategy that can offer a range of tax benefits, provided that it's handled correctly, and it's increasingly popular among property investors looking to improve their tax efficiency and plan for succession. We'll walk through the key tax implications, the practical steps involved, and the potential risks that need to be managed to ensure that reliefs are preserved. The primary objective of incorporating a property portfolio into a limited company is to achieve tax efficiency. Rental profits earned by the company will be subject to corporation tax, which is lower than the higher or additional rates of income tax paid by individual partners. Incorporation also allows greater flexibility in how profits are extracted, making it easier to distribute profits in a way that suits family circumstances and minimizes personal tax liabilities. This flexibility can become even more valuable if the business is intended to be passed down to future generations. Succession planning is a major driver for incorporation, as ownership by a company makes it easier to transfer value within the family while managing inheritance tax exposure. By structuring shareholdings appropriately, older family members can transfer value out of their estates while still receiving income from the company, something that is far more difficult with personally held property. There are also benefits in terms of operational flexibility. A company can more easily reinvest profits, expand the portfolio, and manage risk. The limited liability protection offered by a company structure also helps shield personal assets from business risks. The incorporation process itself involves the sale of the portfolio from the partnership or LLP to a new limited company at market value. The purchase price is typically satisfied partly by issuing shares to the partners and partly by the company taking on the partnership's existing mortgage debt. This brings us to the key tax implications, starting with capital gains tax, or CGT. Transferring the properties from the LLP to the company would normally trigger a chargeable gain based on market value. However, incorporation relief under Section 162 of the Taxation of Chargeable Gains Act 1992 can defer this gain if the portfolio is transferred as a going concern in exchange for shares in the company. To qualify for this relief, the partnership's property rental activity must be considered a business. HMRC has historically resisted treating property letting as a business, but the case of Ramsey v. HMRC in 2013 confirmed that a sufficiently large and actively managed portfolio could qualify. In this case, if the partners spend a significant amount of time managing the portfolio, dealing with tenants, arranging maintenance, and making strategic decisions, it is highly likely that the activity will be accepted as a business for these purposes. That said, this is never completely guaranteed, so it's an area where careful preparation and documentation is essential. Incorporation relief also requires that the whole of the business's assets are transferred, apart from cash, and that the business is transferred as a going concern. Provided all these conditions are met, incorporation relief should defer the capital gains tax on the gains arising from the transfer. One complication involves the transfer of mortgage debt. Her Majesty's Revenue and Customs generally treats the assumption of liabilities by the company as additional consideration, which would reduce the relief available. However, Extra statutory concession D32 provides that liabilities taken over by the company do not count as consideration for incorporation relief, provided the liabilities are properly transferred. To meet this condition, the mortgage debt must be formally novated, meaning the new company legally takes over the loans and the original borrowers are released. In practice, this can be difficult to arrange, as some lenders prefer to offer new loans to the company rather than novate the existing ones. There's ongoing uncertainty over whether HMRC would accept incorporation relief where loans are refinanced rather than novated. The Chartered Institute of Taxation has asked HMRC for clarification on this point, but no formal response has been issued. As a precaution, it may be sensible to seek a non-statutory clearance from HMRC before proceeding if novation proves impractical. Another potential pitfall is the use of beneficial interest trusts, sometimes promoted by advisors as a way to avoid the need for novation. Under these arrangements, the company only acquires a beneficial interest in the properties, not the legal title, while the old loans remain in the names of the individual partners. HMRC has raised concerns about this approach, and there are ongoing inquiries into whether such structures constitute tax avoidance schemes requiring disclosure under DOTAS. For this reason, I do not recommend this approach. The value of incorporation relief may also be limited if the gain being deferred exceeds the value of the shares issued to the partners. However, in most cases where there is significant mortgage debt, this does not present a practical problem. Turning to stamp duty land tax, or SDLT, a relief under Schedule 15 of the Finance Act 2003 can eliminate SDLT on the transfer of properties to the new company, provided the shares are issued strictly in proportion to the partner's income entitlements in the LLP. Any deviation from this proportion would result in an SDLT charge. It's worth noting that anti-avoidance provisions in Section 75A of the Finance Act 2003 allow HMRC to disregard steps in a transaction designed solely to avoid SDLT. However, where a property LLP has operated normally for some time before incorporation, HMRC does not generally take the view that the LLP itself is an avoidance step. After incorporation, rental profits will be subject to corporation tax, and income tax will only arise when profits are extracted by way of salary, dividends, or other payments to shareholders. This allows for more flexible and tax-efficient profit extraction strategies. For inheritance tax planning, ownership through a company offers several advantages. Shares can be structured to facilitate transfers to the next generation, and trusts can be used to manage succession and protect family wealth. These options are far more difficult to achieve with directly owned property portfolios. The practical steps involved in incorporation include obtaining formal property valuations, restructuring mortgage debt, drafting and executing legal documents such as the business transfer agreement and shareholders agreement, and completing all necessary Companies House and tax filings, including SDLT returns and CGT computations. Post-incorporation, it's important to develop a clear tax strategy, including dividend policies, director remuneration, and succession planning tailored to the family's needs. This should be reviewed regularly as tax rules and family circumstances evolve. Incorporating a property portfolio can offer significant tax and succession planning advantages, but it is essential to manage the process carefully, particularly around mortgage debt and ensuring all conditions for reliefs are met. In some cases, seeking advance clearance from HMRC may be advisable to provide greater certainty. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next and future episodes.